Hi, this is Ron Rowland for Money and Markets TV. All traders fantasize about bottom fishing, picking up a stock or ETF at a rock bottom price and riding it sharply higher. But calling a bottom is one of the hardest challenges that most investors ever face, and one wrong decision can devastate your portfolio. That's why I want to use this opportunity to illustrate the difference between an ETF that is cheap and one that is a value. Then I'll tell you about a different approach I've used successfully for decades. As an example, let's look at the performance of the Guggenheim Solar Energy Fund, ticker symbol TAN. In May of 2008, it was trading at $30.79 a share. Think about what the economic environment looked like back then. The financial crisis was still unfolding, Lehman Brothers was still in business, and most importantly, crude oil prices were north of $150 a barrel. Capital was abundant and alternative energy was a growth sector. If oil prices had kept marching higher, TAN may have been a good buy around $30. But as we know, that's not what happened. Just 2 months after reaching that level, TAN had slipped by 23% to $23.60 a share. A bargain? Some folks probably thought so. But by September 30th, 2008, TAN was down to below $18 a share. And 2 months after that, it had dropped all the way to $8 and change. And that wasn't even the bottom. By March 6, 2009, TAN was as low as $4.65. It had lost 85% in a little over 7 months. Anyone who called the bottom before that probably lost their shirt. Now, once it dropped below $5 a share, it really was a bargain for anyone brave enough to buy it and smart enough to know when to get out. It ended up rising as high as $11.67, but it didn't participate in the nearly 2-year-long market rally that followed. By February of this year, TAN was at $9 a share. At that price, it again seemed like a bargain to many investors. After all, it was still more than 70% below its former peak. But as any shopper knows, what is on sale today can easily be on clearance tomorrow. And that's exactly what happened with TAN. Since February, it's tumbled another 61%, all the way down to $3.50 earlier this week. In other words, TAN was cheap, but it was not a value. Now, TAN may finally be near its long-term bottom, but who knows? Plenty of smart people thought it was a good buy at $30, $20, $10, and $5. But the truth is, no matter how cheap a stock or ETF may look, it can always fall further. That's why I prefer a price momentum approach to investing. I buy ETFs that are already moving higher because the odds of further upward movement are better when that movement is already happening. Decades of research prove to me that this approach works better than looking for value in weak market segments. It's true that if you use this momentum approach, you'll never buy at the bottom or sell at the top. But if you think about it, value investors can't buy at the bottom and sell at the top either. The most famous value investor in the world, Warren Buffett, became so successful because he's patient with his investments, but also because he can afford to sit on a loss for years until it turns around. Whether you decide on value, momentum, or some other investment strategy, it will only pay off if you stick with it. I'm Ron Rowland for Money and Markets TV. Thank you for watching.